My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Mr. Christian Fromhertz, who a lot of people that I follow as well. So I'm excited for this conversation. Christian, for those who are not familiar with your background, introduce yourself. Who are you? How'd you get involved in markets? And what in the world is Tribeca Trade Group?
So I can't. So you're only doing 5 of these today, huh? That's geez,
yeah. I'm trying to take it easy today.
All right. Well, I wish you luck over the day. So thanks for having me on. I really appreciate it. My background is I started trading, or I should say, my financial career, right out of college. I started off with a firm that you don't even hear these days anymore because it's not around, but that's Dean Witter, which was later bought by Morgan Stanley. But I started off my career as a financial advisor. That was a great way to kind of start out of college, get some sales experience along with some trading. Long story short is after a couple different swerves in my career path, really wanted to get more into trading rather than sales. And, again, it's one of these things where you start off out of college and it's really good to experiment, get your feet wet, understand that you may not get into something that you really want to be into right off the bat. Give yourself some patience, time to kind of do all those things after you start, or if you're just into trading now, give yourself a chance to try different approaches. But long story short is I worked at Merrill Lynch. I made the transition over to institutional trading through kind of a non-traditional path to get there, worked my way up all the way from the bottom to get to a trading desk, which was a Delta One trading desk, which was, again, great exposure because you trade so many different products on a Delta Trading One desk, thing from futures to ETFs to customized indices to outright stock trading. So that was really, a cherished time in my experience to be able to work on an institutional trading desk right in the middle of some of the most volatile times that we've seen, in the financial crisis. So I make a lot of references when I see a lot of references to 2008, 2009. And, a lot of people, I think, kind of trying to compare this time to that. And while there's a lot of history that we can kind of take from 2008, 2009, and again, we don't know if what we're experiencing now is going to develop into that. But right now, we don't have those types of situations. But it's interesting to see a lot of traders kind of make the comparison. Fast forward, a few years past that, I transitioned over to Bank of America, which, again, if you were trading or working in the financial industry at that time, it was a very interesting time to get through because you weren't so much as worried about, hey, where's the stock market going to bottom? And, am I going to miss the turn? You were more worried about job security back then. So I was very happy, lucky to be in the right position to be able to kind of get through the financial crisis, and worked on a great trading desk. So we transitioned over to Bank of America. I did that for a number of years, worked my way up to director. I was one of only 2 institutional traders that managed our whole ETF trading desk. And from there, basically, as anyone works in the institutional field for a while, you kind of have possibly a long life or a short life, but things really change in terms of if you're on an institutional trading desk, managing who's running it and so forth. So what I decided to do after a number of years of doing that is to start my own business. And that's the Tribeca Trade Group, really kind of touching upon a lot of things that I did over my career, a lot of macro approach, and kind of take that to, trading for my own and trading my own money, educating others on how markets work. A lot of, what I've kind of done over the years is adapt and change my style to how the market moves. So I've really kind of fallen in love with trend trading, which, this year have seen a lot of trends, different trends than what we've seen over the last couple of years. But we could talk a little bit about that, and kind of brings us to today, where we are. And I've now been running the Tribeca Trade Group for a bit over 5 years. And it's a challenge every day, especially in this environment, compared to what we experienced just last couple of years. And it's been such a crazy market. We've seen so many different themes play out. And this year, I think, has been very much a reversion to the mean, as it should be. I think things kind of got out of hand the last couple of years, but which kind of brings us to a new year. And I think I'm calling this year so far two different themes, basically. One is a reversion to the mean, and number two, like a major reset button in terms of all the speculation that we've seen over the last couple of years. So, which, brings us to a new year. And I think it's going to be pretty wide open. There's a lot of different expectations, and I think a lot of negatives kind of going into this year. And I think that I don't like to make a ton of predictions because I like to let the price action really kind of give me a sense of what is going on in the market. So I think that's going to be really interesting as we start the year.
What I like about your background is that you're not just some, respectfully to some people I see on Twitter, trader in a basement that doesn't know what the industry is like. And I don't say that in a disparaging way. What I'm really addressing there is that, when you're in the business of investing, it's a different animal than investing itself. You talk about being a financial advisor, having the sales experience, and I think you'd probably agree with me that, the reality is a lot of fiduciaries in our industry really are just very good salespeople and are, I would argue, in many ways worse than their clients in terms of chasing the next hot dot, right? They're not necessarily big fans of mean reversion. They tend to be kind of more momentum players and more sticking in the middle. Do you think that we're ever going to get to a point where there's maybe more thoughtful market analysis from those that are supposed to be the stewards of capital? Because the reality is, if you stick your neck out doing something different, whether you're creating a strategy or an allocator, that's a very easy way to get fired.
Yeah, I mean, it's a great question. I mean, I think that one of the really cool things that's come about in the last few years is that your ability as a trader, investor to get different types of research, get different types of approaches to this market, you can get so much more information than you used to get. And so that means that, okay, the little guy, in terms of having a small business and kind of like myself, the world is your oyster in terms of if you've got great ideas and if you don't necessarily, it helps to be a good salesperson too, but I'm not a good salesperson. And that's kind of why I got out of that role. Again, it was great experience. And it's important to understand the different mindsets to go into that. But I'm not a great salesperson. I consider myself a pretty good trader. And in this environment, you can get your voice out. I mean, that's the beautiful thing about Twitter and so forth, is that even the tweets that you send, if they're not really catchy and so forth, if you're sending out good ideas, people are going to notice. Going back to your question, are some of the bigger houses and so forth, are they going to become or stay relevant? I mean, they're going to have to adapt like everybody else. I mean, they've got a lot. I think that they have a lot more competition now. So, I think that world, let them have to basically have to change and adapt, which I think that they will need to. Otherwise, they're going to kind of fall by the wayside a bit.
All right, let's talk about some of those two trends, the reversion to the mean and the sort of major reset. I mean, I think you can argue that you've seen that in multiple asset classes at the same time. The main one, as far as the reset goes, clearly is the bond market, right? We've seen all these stats, worst year for Treasury since 1788 or something like that, and one of the worst years for 60-40 in history. Do you get the sense that stocks are fully done with their reset? And I say that because, the reality is, yes, it's. I just put the tweet out. It's the fifth worst year on a real return basis for the S&P going back to 1926. But at the same time, valuations are still high. I still see a lot of overconfident bulls. What's your take on where we are on a reset for stocks versus bonds?
I think that for stocks, I think that we're closer to the end, but I don't necessarily think that the end is there. I do think and know over time that all bear markets do end, just like bull market. All bull markets end too. So I do think it's a matter of time. One of the things that I keep coming back to, and I keep saying, is that if you're mainly playing on the long side, right, and if you're more of an investor and you're not doing a ton of shorting, the word that comes up a lot is patient, right? One of the things that probably know, hear this term a lot too, or hear this phrase a lot, is that bear markets do wear you out, right? And by the time that we do make a low, a lot of times, people aren't ready to kind of buy that just because they've kind of gotten exhausted. So to your point, I don't know if we're there yet. There's certain days, even, it kind of comes to mind, like even a little bit yesterday too, because I got out of a couple of positions that I was in, and you just kind of feel like for the day, and then you get over it a few hours later, but you kind of feel defeated for the day. So there's been certain times this year where you get to the point where you're like, geez, this is a very hard market to trade. It's a bit frustrating, but I try to really stress that with how the market is behaving and the twists and the turns, that this is not a place to really be committing a lot of risk. So I don't think, and hopefully knock on wood, I won't get to the point where I'm going to get, to the point where I'm just like, geez, you're ready to throw in the towel. I mean, you might get a little bit bored of it and a little bit tired of the price action, but I don't know myself if I'll get to that point. But I agree with what you're saying. There's a lot of people that as soon as we see, all it takes sometimes is one day where we get a bounce and everybody's all excited again. So that tells me too that, hey, we're not there yet, most likely, to the downside. And even we could talk a little bit about what groups of stocks too. I mean, look at the Qs. The Qs made a new closing low yesterday. So that should tell you too that we're not there yet.
Yeah, and I will say before bringing in some of the audience that I made this point before. The real bear market to me started February 2021, which was a week after all the GameStop stuff started getting in the headlines. When that spike occurred, that's a few weeks after that is when emerging markets peaked, small caps started going sideways. But it is interesting, right? Because I'd argue you need to have a prolonged bear market to really train people to stop buying the dip, or at least having that be the automatic response when there's a decline. Because, for the last decade, you've had this kind of sequence and path in markets where stocks go down and then it doesn't last very long. Stocks go down, doesn't last very long.
Right.
The only way you break that is with, much more time to kind of break old habits, I would argue.
Yeah, exactly. And yeah, I mean, it is concerning that people want to buy the dip, and they want to buy the dip in the same stocks too, which are in decent declines. And, I would argue that obviously the FANG stocks, right, which got overcrowded. They did become kind of an easier trade over the last couple of years, but I still don't see traders kind of relinquishing, saying, hey, I know Apple and Tesla are the two big names that everybody are talking about right now, but even throw in Amazon, right? Those names just may not come out of this with the same, and they haven't been showing leadership for a while. But I think, just going back to the mindset, I think that there's so many traders that think that these are still going to be the names that are going to, push higher and be the market leaders of the year to come. And I just don't think that that's the case. And I agree with you to the standpoint, like, if you look at that group, there are still too many traders who just think that these stocks are going to go right back to the prominence that they once were. And I know you've been trading for a while. And when I started my career, a couple names that came to mind back then were, like, when I first started, it was AT&T and IBM, right? Everybody had their money in those stocks. Those were the leaders, and it was the same type of mentality. Everybody was thinking, oh, you're not going to buy AT&T, you're not going to buy IBM on the dip, that type of thing. And that's changed over the years. And really, when I kind of started my career too, it was even names like Cisco, which were the behemoth back then. And, everybody was buying the dip in that name for a while until people kind of forgot about it. So that's the stage I think that we're at right now.
Let's go to some of the audience.
That's a great question. And I think, this is one of those years and times that adapting to the circumstances, we haven't really even gotten to the Fed, but I think with the major momentum that we saw even before 2020, but the fundamentals were just, when you had the Fed pushing as they were, and inserting all this liquidity into the system. And, you saw one group that stands out to me is the software group that was trading the price to sales ratios for these things were just, crazy and got to the highest levels. Now, you could have argued that for 6 months, a year, that the price to sales ratio in the software group was out of hand. But even though you were right, if you ignored the trend and if you weren't trading that group, you were really missing out on big returns. So it's an interesting thing. The fundamentals do matter, but sometimes they won't always line up exactly when they should in terms of, hey, these things don't make sense. The market can, as we know, the market can not make sense for a long time. And that's why I think paying attention to price and trend is important. There will be a time when those things break, and they did, but trying to predict that based on the fundamentals are very difficult. Fast forward to now, I do think the fundamentals matter so much more because obviously what the Fed is doing, and now people forget how long interest rates on the long end of the curve and the short end of the curve too. I mean, you had 0% interest rates for a number of years. So it did kind of make sense why there was that speculation and so forth. But now when you're talking about an interest rate around 4.5%, we could get to, whether we get to 5.25, I don't think that's going to matter too much, but it does make fundamentals much more important given the level of interest rates. So while I'm not an expert, I wouldn't say that that's where my bread and butter is with the fundamentals. I think it's important to understand both in your trading and in your investing. The more well-rounded that you can be, understand, and if you're more of a fundamental person, understanding the trend and the technicals, I think can help you in that analysis as well. I guess that question is for me, but we can both try to answer that one. There's always a possibility. There's always, if you look at any time, there's always, and I think really what helps to look at markets is the probabilities, right? And it's the same thing when looking at putting on a trade or even thinking in terms of investment is to think about things in terms of probabilities. So we're never going to get around that issue that there's always going to be some chance because it has happened, right? It happened in 1929, happened in 87. It happened, clearly there was the Great Recession in 2008. There was a flash crash. So there's always a chance that things can happen. Like I saw someone the other day predicting, there's going to be a flash crash in 2023. Okay, but I can't really make money thinking about what's always the possibility of always something going wrong. I think that's really where technicals come in for me. If we're trending down and right now we're below all the moving averages, you can look at any one that you want to right now. We're below all the moving averages, 5-day, 20, 50, 200. So to me, that means, reducing risk. And we can't control whether or not the inflation rate, unemployment rate, if the unemployment rate jumps higher. What you can control is your risk. And to me, one of the things that I try not to do using the technicals is try to pick a bottom and try to pick a top. So while things get cheaper and cheaper, I like to be in the position, which kind of I am now in my trading account, to basically say, let these things let someone else figure out where they're going to bottom. I know where I'll be in this market once things start turning back up. And once we start to see more participation in the market and breadth expands, but I can't really speak to that possibility. It's always there that the market could crash. It's always a possibility that things go much lower. And one of the questions right in the beginning was, do I think that we go much lower? I think it's a possibility. Again, I think we're more, as Michael said, he thought that the bear market started in the beginning of 2021. And that's several groups of stocks that kind of gave that signal. You could also argue that the bear market started at other times. But regardless, we've now been in this bear market for a while. Sure, it could continue to go on. And I'm not going to try to give you the exact time of, because I don't know when the bear market will end, but I know what to watch for when things will start to, get better, and possibly when they start to turn up, whether or not that constitutes, the final bottom. And again, we won't know 100%, but that's what trading is about, and making an informed judgment with the information that you have. And I think what I really try to do is get traders comfortable with understanding that you don't need to try to predict. Be patient, let these things play out, let them work their way out, and we'll go from there, and we'll get aggressive. Once the signals, and knowing what to look for when you start to see those, then you can act accordingly.
Let me add some thoughts, because this is kind of, I've been on this kind of conditions versus predictions point for a while, and you said it correctly, Christian. You can only control your risk, right? Which I like the analogy of driving when it's raining versus when it's not raining. That it's ultimately about, you don't know the exact mile marker that you might crash your car, but you know the conditions under which you need to slow down in, which is your risk. And I find people get stuck on the idea of the call. And I always go back to this point that the call is irrelevant. What matters is, given the same set of circumstances, based on history, based on data, would the probabilities favor some kind of an extreme tail event? Now, most major crashes, corrections, and bear markets do tend to have certain markers, right? And those markers, you can correct me if I'm wrong on this, Christian, but most of those markers are ultimately related to liquidity, right? So when you're in a less liquid environment, that's when you tend to have gaps. That's when you tend to have major, major declines. So then the question becomes, well, what are your indicators to identify the conditions that tell you liquidity is lowering? A lot of different ways of doing that. In my world, it's lumber relative to gold because of the credit creation impact of housing. In my world, it's utilities because utilities benefit from risk-off defense, kind of environments. So to your point, I keep using the line, just because it's raining doesn't mean you'll crash. Just because it's sunny doesn't mean you won't. It is amazing to me when I put that thread out December 2nd, people say, oh, we didn't crash. It's irrelevant. We so far, at least as of yesterday, you've had the fourth worst December or third worst December. I put the tweet out earlier in history. The idea of the mile marker is not what matters. The idea of the conditions and the weather around you, that's all that matters when you're trading and investing. And you're not going to always get it right either.
Yeah, the liquidity point is huge right now. And I like that you. So first of all, great call. You've had a couple of great calls this year, and congratulations. I've been paying attention to.
And let me just say, and not to interrupt, but those calls didn't mean anything. As you know, right? This is the only domain in life where, when it comes to investing, where you can be right and still lose money, or wrong and make money.
Yes, very, very much so. Yeah, and at the end of the day, your P&L matters, and how you carried out the ideas and your thoughts and the strategy. So that's important. But I love how you use a couple indicators that or you mentioned a couple indicators that I don't. You mentioned lumber and gold.
Lumber and gold because of the housing, right? Housing starts mechanism, and then then utilities, and it's ultimately all about interest rates,
right?
Demand for money changing.
I like that, so I'm going to use that. One that I use a lot too is kind of like a danger barometer is credit spreads, and I'm not a fixed income expert. I don't pretend to be, but it is important if you're mainly an equity trader to be definitely looking at what's going on in interest rates right now. And also, if you can kind of throw in a couple added dimensions to that, which is, looking at and understanding what credit spreads are telling you. Credit spreads, when you look at high yield, it's the other way around. When you look at treasuries over high yield, you can understand if basically, spreads are blowing out, if things are getting much worse in the credit market. And really, it's been interesting this year because there's been such a move, and I see it on Twitter a lot of times, or I saw it earlier this year, where people were looking at HYG and they were saying, oh my God, this looks horrible for credit. And I'm like, well, you have to understand that there's multiple, the way that you analyze a bond, right? There's interest rates, there's credit, right? So there's a couple different components. And what we saw earlier with high yield, and again, it doesn't, if you were short high yield If you were short TLT, it doesn't matter. You made money. So you don't always need to understand everything to make money. A lot of times, sometimes even the less that you understand, sometimes is the better if you're just basically following price, which is fine. But HYG went down because of the interest rate component. And the only really way to kind of compare that credit risk is to look at that with the similar duration. So again, if you're looking at HYG, you've got to understand what the duration of those bonds are, compare them to treasuries, and and have the right duration, which for HYG, it's IEI. And if you look at the two of those, we're not seeing credit spreads widen out like they did. And that's why I always, we started in the beginning of this talking a little bit about 2008. And currently, that ratio looks nothing like 2008, 2009. Now, of course, it could change, right? And, again, we go back to what the Fed is doing, and the Fed's looking at that too. And they're also, looking at this and saying, hey, well, we don't need to do what everybody seems to want to use the word pivot. They don't need to necessarily pivot because spreads are not getting blown out yet. And they're not, I don't know everything that the Fed looks at. There could be something else that's happening somewhere else. They're looking at clearly with this historic move and moving up interest rates as they are, they're going to be looking for warning signs that what they're doing is moving too fast, too quick. But if you look at credit spreads, we're not seeing that stress yet. And that kind of gives them a little bit of leeway to keep doing what they're doing because those spreads are not getting blown out yet. So anyway, so sorry, long-winded point to make there, but it is one of those things that I look at every week to say, hey, are credit spreads looking anything like they did back in 2008, 2009, or 2020 when they blew out there too? So there's a number of different indicators, and I'll be looking at the lumber to gold because I think that that's very interesting. But these things can kind of give you a little bit of a barometer for how bad things currently look outside of the price action in equities.
Yeah, no, 100%. And actually, everybody here, please make sure you follow Christian Fromhertz, as well as check out Tribeca Trade Group and all the research he puts out there, and follow all the fine people that are helping me with this conversation. I will say real quick on credit spreads, you're spot on. I mean, the Fed's not going to stop raising rates until you have default risk premiums getting priced in. One of the great frustrations this year is that it's been pretty much all duration, no spread movement. Real quick on the lumber to gold utilities, and this goes to this research I put out, the dynamic of risk on, risk off is ultimately about volatility in stocks. So, which again goes to illiquidity and kind of tail events. There's a link between VIX movement and option adjusted credit spreads, right? So usually when you see the VIX spike in equities, you'll see credit spreads widen. Volatility tends to be perceived as increased default risk in the bond market. The idea of the indicators telling you the conditions is that you tend to have volatility rising on average when lumber is weak, when utilities are strong, which means they tend to warn you in advance also of the spread widening. So yes, spreads are leading, but at least from the research that I myself seen, what precedes even the credit spread widening is the weakness in lumber and strength in utilities. That you used the keyword yet there, right? This could be the real story for next year.
Well, I don't use that to identify a bottom. I just use that to basically give a sense of overall risk in the system. And if things are getting worse, if things are really kind of flashing that warning sign, right? And I mentioned right now, we don't have that. I do look at like a number of other factors, but trying to think of one specifically that will really kind of show things getting extreme. I'll look at things like, there's a couple ratios like the NIMO, the NAMO. I'll look at basically overall advancing versus declining, which will kind of give you a sense, which I don't think I'm not necessarily answering your question, but I'm looking at various different personalities of what the equity market is looking like. Right now, we've got very weak breadth. Not only do we have weak price action, but we've got weak breadth. So I tend to look for things that are either I tend to look for divergences. So when we get to the, whenever that time comes when we arise at or get to the potential bottom, right? What I would tend to look for then is divergences, right? I want to see really the number of advancing issues really kind of change personality in terms of the decliners. So those things are normally present. You'll start to see various different divergences when you start to look under the hood, or and you'll kind of get like a light bulb go off in your head that will basically say, hey, something is acting very differently here. Even though price is still going down, things are starting to change. So I don't see that yet. I don't see any major changes yet. We have seen, a couple of times this year, we've seen little things that are showing some improvement as we've reached the lows. But as we've kind of seen these twists and turns throughout this year, then we really kind of see things back off. And it does go back to liquidity, and it does go back to what the Fed is doing. Every time we have one of these Fed meetings, and Jerome Powell mentions that they're staying the course for now, those kind of seem like they're important points in terms of seeing the market kind of flip at that point or thereafter, and looking at what Fed fund futures are telling us in terms of the pricing and what that's expecting as well, what the market is pricing in. And I think what's interesting too is, again, like I don't always, people, and again, it's a great question. People always want to compare what we're going through to some other time. Oh, this looks exactly like this time, or this resembles that. And, I think you hear the term like history does rhyme. And I think it's important to pull different situations where there may have been different things going on, but you can kind of see these types of divergences, and you could see similarities because those things will repeat. To try to answer your question, I think we're just going through something different. You could say that there's some similarities between what went on with the dot-com bubble, right? There was a set of stocks, there was a group of stocks that went ballistic, went far above their valuations, and that happened for quite a bit of time. And then there was a pretty long, there was a prolonged sideways pattern in some of those stocks, and a lot of those stocks didn't make it. A lot of those names that hitched on at the very end and said, hey, we're going to put .com in our name, right? Without any major fundamentals. And going back to the question earlier about fundamentals do matter. Eventually, they'll revert, and let's talk a little bit about reversion to the mean. Things will come back to where they really should have, and that's the period that we're still going through right now. Many of these names that had a great story to them but had little fundamentals, right? Well, the story is coming undone. So I think that you can draw from some of those timeframes, and you could look at various different other timeframes. I mean, that the situation too that we're experiencing with inflation, that wasn't that, as far as I remember, that wasn't a major point back in 2008, 2009. It was in the 70s. And there's some similarities that you can draw from there, and watching what's going on with inflation right now and noting that it does take time. Now, there's some differences too. I think that everything is faster nowadays. The information flow is faster. So it does kind of give me some optimism for this year that the time could be kind of crunched a little bit, because and again, this is just what I think, but I don't think that we're going to go through years and years of waiting for inflation to come down or the market to bottom. I do think that we could go through, and again, it depends. You made a point about industrials, which, look pretty good right now. That should tell you something, that, why are the industrials acting so well when everybody's talking about a recession? And of course, I don't have the answer to that, but I'm not sure if they're just executing much better, like a Caterpillar, which is very close to the highs of this year. So again, it's such a head scratcher of a year to see a Caterpillar just about breaking out. And to me, that's what's so interesting and fun about the market, is that you're not always going to get all the answers, right? Why a Caterpillar is breaking out, and so many other names in the industrials are doing well, when everybody says we're supposed to be having this big recession. So
But it is interesting, Christian, your point about being a head scratcher. It's like that's happening at the same time healthcare is rocketing relative to equities. It's
Yes.
happening at the same time utilities are rocketing, staples are rocketing, like all the defensive sectors. And by the way, that's happening while treasuries are still largely weak, which again remains is again one of those massive divergences and disconnects. So I think you call it fun, I call it hell, right? Because it's hard to really get a sense of what to do when you have so many conflicting signals.
Conflicting signals, conflicting themes. Some of the things that you just highlighted too, and well, this is where I do think it's kind of fun because you have to be a little bit of a detective. You have to be like, okay, well, what's common in some of the areas that you mentioned? Well, yes, they're defensive. B, they also give out dividends, which people like the comfort of dividends, and they are trying to go and position into some of these safer areas of the market. Healthcare is a really interesting story too because it is very defensive, but you also have a lot of themes going on right now. People are getting older and they're going to need more care. I've seen that on a personal level with my parents over the last couple of years. So you've got that area I like a lot because you've got a couple different catalysts at work there. So again, this is what makes the market really interesting. But yes, going back to the original question, you could pull themes from there and understand that some of these areas of the market just may not be done going down because of the ascent and the overcrowdedness and a couple other factors that we could talk about too, probably. A couple of things that I've said with, comparing what happened with the financials in 2008 and 2009. It's not to say, and I think Michael has said this too, it could be that we're not there yet. I mean, things could take a turn and go worse. And I think that you have to have that scenario in your mind to say things could always get worse. It's a possibility because I don't fully grasp everything that's gone on in the crypto market in terms of the depth of, what the fact that people were giving so much money to these funds and not fully understanding, right, what their business was and what they were doing and not investigating. So there's that seems to be kind of a factor that is at play with some of the corrections that we've seen previously, is that there's always this giving money or having exposure to an area that you shouldn't have had exposure to. And will that get bigger? Will that get worse? I mean, it's a possibility. I don't think it's nearly as bad as what we saw with every situation, the amount of exposure that the banks and different financial firms had to bad mortgages. But it's a dent for them, not as big of a dent, I don't think, but it's definitely interesting to kind of watch and to pay attention to who has the exposure and so on and so forth. So that's another factor out there. It's something to always keep in mind that things could get worse, and what are you going to watch to monitor where the warning signals are and so forth.
Talk about systems development for a few minutes here, Christian, before we wrap up. So I'm a big believer in back testing. Some people don't believe in back testing, but they believe in buy and hold. And I keep going back to buy and hold as a back test too, with one trade, but it's still a back test. Do you implement systems with your own trading? Do you do a lot of back testing yourself? Talk about sort of your own research on what works and what doesn't.
Yeah, sure. So, and it's good to kind of incorporate a little bit more trading and so forth into this conversation. But yeah, I mean, I think it's very important to kind of develop your own system. And I think that comes, and again, it doesn't mean that you have to like develop an indicator or, get really into the weeds with that. But what tools are you using? What tools are you going to use to help you make decent decisions, make as many informed decisions as you can? So, I try to teach all levels of traders, and I try to tell them, incorporate this or incorporate that. This is the system that I use. This is why I use it. But you can incorporate other methods. And it's really what ends up being comfortable to the user, to the trader. So yes, so over the last few years, I've, along with one of my colleagues, developed like an indicator that helps me really spot trends and understand breakouts and as well as breakdowns is what we're seeing more so this year. We're working on back testing it. We're working, we're kind of dependent on one system right now, but I think that's important. It's also just important to kind of understand how the technicals work over time. Looking at some stocks that we've got a number of stocks that haven't finished, it doesn't appear that they've finished going down, right? Well, what is it going to look like when a stock does bottom, right? In terms of what's the probability of a V recovery? Well, you could talk about the Fed getting involved for something like that. If you don't get that, what are some other characteristics of how a stock bottoms? A lot of times stocks go sideways for a year. I mean, look at the Chinese, the emerging markets were brought up a minute ago. Look at the Chinese internets. Now, I'm not sure if they're ready to rocket higher and completely trend higher without any issues along the way, but they did spend a certain amount of time going sideways, which is what you want to see after a prolonged downtrend, which is what you saw in the China names for a while. So to answer your question, like to develop a system is important. I look at volume at price incredibly. That goes into the indicator that I use. I was going to share a couple charts, but I can do that a little bit later. But and I like to look at that in terms of multiple time frames. We're going to have, obviously, in just 2 days, we're going to be in a new year. So, looking at what that indicator volume at price, I use value areas to kind of give you a sense of roughly like one standard deviation of the time, the price, and the volume can give you a really good sense of support resistance. And it's going to be interesting where things kind of line up, whether some areas are going to open up below. I know this is getting in the weeds a little bit, but if they're going to open up below the value area for the year, to me, that's easy. They're still trending down. If something opens up inside the value area, which, a value area can kind of give you a sense of if we're range bound, right? So that could give us a sense that we might start the year off. I don't know if that's how we're going to end the year, but we could start off in a sideways type pattern. And again, it's going to depend on what area of the market, as some stocks are faring better than others right now. But back testing, that's something that we're going to be looking at doing more and more as we kind of push the indicator that I use quite a bit off of a system that we're using and possibly onto another. And that's important. And testing it, and also not just doing like the back testing doesn't have to be like an automated type system. It's really kind of in your trading going back. I tend to do this review at the end of every month, and I go through my biggest winners, go through the biggest losers, right? You have to hold yourself to finding out what you did correctly, what you did poorly, and trying to really eliminate the mistakes of being, the poor results. Like, why did those poor results happen? Right. And you can't blame the market. You can't blame, we have some fund managers saying, oh, well, it's the Fed's fault. Well, okay, that's great. That you can, if you really want to go down that path of saying, hey, it's not my fault, somebody else's fault. But really, I think you have to own up to this market's going to do whatever it wants to do, right? You're the pilot, right? You're dealing with all the different circumstances. You mentioned a car on a road. I like the pilot and dealing with bad weather and so forth. And there's different tacks that you can take to steer yourself and get yourself and understand when you've got bad weather, right? And when maybe you don't fly that day, right? And so those are all things I think that you kind of figure out a little bit as you go along, but you have to go back and review at the end of if it's too long for every month, you do it at the end of every week and understand, like, how did this happen? How did you have this loss, or how did you have this nice gain? So you got to do both. You got to go through the losses and the gains. And one of the things that I think is important, I went over my background, but I've been doing this for a long time. You still have to go back. There's a lot of human behavior, and you're never going to get to the point in this game where you figured it all out, right? And you're like, oh, geez, okay, I figured this game out. It's done. It's going to be easy from now on. That's not the case. You always have to go back and kind of retrain yourself to understand. And this year is a great year to be like, okay, this is a different market than we experienced the last couple of years. You have to kind of really be up, and now of course we're coming to the end of this year, but this year's been all about risk management, right? And understanding your stops and where you're going to take targets and trades. But I could go on forever about this, but I'll go. We'll see if I think we just have a few more minutes. So
yeah, no, that's great. And again, everyone, please make sure you follow Christian Fromhertz and everybody up here who's kind enough to help me during this long day with these various spaces. Christian, this is there's a lot of things that I enjoyed in hear you talk about market, talk about your background. I would love to have you come back on with a couple of other traders as well. Everybody, thank you for joining. Thank you, Christian. Thank you, everybody.